From the CUBE studios in Palo Alto and Boston, bringing you data-driven insights from the CUBE and ETR. This is Breaking Analysis with Dave Vellante.
Based on this quarter's earnings reports, it's clear to us that demand is not the constraint for hyperscale clouds. They are, however, running headlong into the hard limits of physics. Access to megawatts, liquid-cooled racks, and a GPU supply chain that begins and ends with NVIDIA are now critical paths to tapping what appears to be unlimited demand. AWS, Microsoft, and Google each chalked up record-setting capital outlays last quarter, collectively dropping around $63 billion in CapEx. Yet even that eye-popping sum can't fully satiate the compute-hungry AI models racing toward trillion-parameter scale. We believe the real story isn't simply AI is expensive. It's that power availability, not revenue potential, is now the gating factor on hyperscaler growth. In our view, the winners of the next cycle will be the providers that can secure sustainable energy footprints, master GPU allocation, offset that with their own internal silicon, and critically, translate all that infrastructure into margin accretive AI services before the depreciation schedules kick in a big way. Welcome to the ironic era where megawatts equal market share. Hello and welcome to this week's theCUBE Research Insights, powered by ETR. In this breaking analysis, we pivot off this week's earnings prints from Microsoft and Amazon and fold in Alphabet's results from last month to give you our most current take on the state of the public cloud. We're going to review the key nuggets from the quarter, give you the positives and the negatives for each of the three firms, update you on our latest 2025 revenue and market share projections for IS and PaaS, share some current spending data from ETR, and close with the key indicators to watch in the coming 12 months and beyond. All right, let's just review on this first slide what happened in the quarter. So we'll talk about a few bullet points here, but the hyperscalers just printed 26% cloud revenue growth. That despite what is generally perceived from other earnings calls that we've heard, whether it's IBM or other retailers, Amazon itself, et cetera, a pretty challenging macro environment. But the hyperscalers chalked up almost $60 billion, $59 billion this quarter in revenue. And one of the key themes that we heard over and over and over again was that access to power and data center, real estate and GPUs, particularly concerns around the supply chain, given all the what we've heard from NVIDIA, is now critical path. This is something we heard time and time again. Operating margins in the cloud are pretty good, but there's a wide divergence. AWS posted operating margin of about 39%, nearly 40% now, 39.2 I think was the exact number. Google Cloud is ticking up, it's in the high 17% range. Remember last year it was negative, it turned positive. Microsoft's opaque, but if you dig into the Microsoft 10Qs, we think the margins we see in the 10Qs, that the margins for things like intelligent cloud are north of 40%, but remember that includes a lot of sort of legacy stuff. But we would think that Azure and AWS are pretty comparable in terms of operating margin. Perhaps AWS is maybe even a little bit more mature or is more mature and hence maybe has a little bit better operating margin. We know that Microsoft is seeing increased margin pressure as the mix of its cloud shifts to Azure. Remember, common thing we talk about on breaking analysis is Microsoft doesn't actually break out its Azure numbers, doesn't disclose its Azure numbers. It just gives growth rates and frankly plays a lot of games in terms of frequently changing definitions. And so that's the item here on C is reporting changes. We've tried to reflect that as best as possible. I'll talk a little bit more about that, but CapEx escalation is back with a vengeance. I mean, the trio, as I said, spent $63 billion in the quarter, and Google alone is telegraphing $75 billion for the year. So pretty amazing. Now, the issue that we have often when we look at the various projections that are out there and we analyze the earnings prints and so forth, is it's really hard to make apples to apples comparisons across AWS, Google Cloud, and Microsoft. Microsoft's a company that's a legacy company that's been around a long, long time. I don't mean legacy as a pejorative. It's something that is actually, as we'll show later, a potential benefit from Microsoft. But it's got a lot of history. It's got a lot of on-prem, so-called hybrid. So it throws out a lot of different cloud definitions. Google, of course, has a lot of software with Workspace, and it doesn't give a specific number on Google Cloud Platform. AWS has, since I think around 2015, actually printed its AWS revenue and its operating margin. So with that in mind, let's take a look at a way to try to compare on this next slide the hyperscale cloud KPIs in the past quarter. So I'm showing the first column, the metric, and then for each of the vendors, and I'll go through each of these line items. So let's start with all in public cloud. IaaS, PaaS, and SaaS, Microsoft about 42 billion this past quarter. I mean, just astounding. The company's going to be north of 160 billion, and it's all in cloud number. That's a number that Satya led with. AWS is that's what AWS reports. So all AWS, IaaS, PaaS, and SaaS is in that number, and Google, 12.3 billion is what it reported. Now, when you dig down into the core, what AWS started back in 2006, 2007, the IaaS and PaaS, that's the core. If you go to the middle here, AWS reported 29.3 billion, and we got a little double asterisk there because we're assuming that AWS's SaaS is less than 2% of everything, but we're just for convenience putting it in here. But really, so that includes a little bit of SaaS, but it's de minimis. Coming back to Microsoft, Microsoft doesn't report its specific Azure figures. We have Azure at about 23 billion. Just digging in, there's reason to believe that number maybe is a little bit aggressive. We've historically been the lowest number for Microsoft Cloud and Azure relative to some of the other projections we've seen out there. You remember we went back and we adjusted our numbers as a result of the leaked court documents and the Activision trial, the $34 billion number, and some other clues that Satya gave in that internal memo. Well, it appears that, and then Microsoft last year changed its Azure definitions. And what it did is we talked about this on a breaking analysis. It brought down Microsoft's actual Azure revenue, even though it doesn't report it, which we lowered. But it increased the growth rates because it took out some legacy stuff around security and some mobile services, and it put in AI. Of course, AI is growing super fast. And so what it did is it lowered the absolute number, which again, Microsoft doesn't report, and it raised its growth rate. So it made it look better because that's all they report. So these are typical games that Microsoft plays, and every vendor plays them as well, but Microsoft is pretty egregious. Anyway, Alex, bring that same slide back up. I'm going to come back to the Microsoft line here in the second row. They did announce 35% constant currency growth, which is astoundingly good. We had them at the high 20s, and they blew that away. And people were super excited. Wall Street was super excited. And AI added about 16 points. We think the Azure AI component will surpass $10 billion this year. So it's really getting meaningful. Again, AWS, IaaS, and PaaS, same number there. Google doesn't report Google Cloud Platform revenue, but they do give clues. They say GCP grew much faster than Google Cloud overall. We think that number is about 6.1, 6.2 billion this quarter. We think they'll do about $28 billion for the year. That is Google. And it'll be about half of its overall cloud business. So, six of that 12.3 we think is GCP. So that's GCP being, the infrastructure, the compute, the storage, the networking, the core. Okay, the next line here, cloud operating margin. So based on the latest 10Q, we think Microsoft's in the low 40% range. AWS is hovering around 40%. Google significantly lower operating margin. Quarterly CapEx over $20 billion for Microsoft, $24 billion for AWS, and the majority of which is AWS Silicon and infrastructure. But remember, AWS also puts CapEx into warehouses for Amazon.com and its retail business. So that's Relative to Microsoft, it's really not apples to apples comparison. And then Google, 17.2 billion, largest component of that is servers and of course data centers. And then I want to make a comment about Google. One of the things I learned at Google Cloud Next is, remember, Google has this massive network, this huge infrastructure of data centers to support its search business. And one of the things I learned is they're constantly optimizing that business, becoming more efficient. And when they do that, it frees up capacity that Google Cloud Platform can utilize for its commercial cloud business, the one that Thomas Kurian runs. That's an advantage that Google has that the other hyperscalers don't have. You certainly see Microsoft going out trying to buy data center space, locating, Amazon's doing the same, locating data centers near power plants, and a lot of talk about nuclear or hydro power, et cetera. Google has an inherent advantage that any optimization it can do on its existing massive network, it can allocate, if it so chooses, to its Google Cloud business. And you might say, well, why can't Amazon and Microsoft do the same? They can, but Google's been at the search business for a long, long time. Alex, same slide if you would, bring that back up. So major CapEx, and the CapEx guide, again, wasn't specific in some cases, except for Google. Go to the right, Google's the only one that really gave clear CapEx guide, unchanged, but it could fluctuate quarter to quarter is what they said. But Microsoft, our estimate is they'll be north of 80 billion, same with AWS. They didn't give a guide, but they said capacity ramps heavily in the second half of 2025. So we feel pretty good about those numbers. I mean, we're talking about, over, 240-ish billion dollars just for these three, and throw in another, 80 billion for Meta, and you're at well over 300 billion for these three plus Meta hyperscalers. It's just remarkable. And then the last one here, the AI contribution. Microsoft says that 16 points of its Azure growth are allocated to or came from AI. So, pretty substantial. There's a fairly complicated math that we go through. It's just simple math, but it's fairly complicated, triangulation that we go through to try to figure out what that actually means and how that's calculated. We'll probably tackle that in a different breaking analysis. Suffice it to say, it's probably larger than the other two. The comments made by Andy Jassy on AWS were generative AI business now is a multi-billion-dollar run rate, triple-digit growth year on year. Yes, of course, because it's a little bit smaller, but so hopefully we'll see some more clarity going forward. Google talked about tight supply for GPUs. It's got its own TPU. They talked about Vertex and Gemini demand, and demand for GCP overall being really strong. They've got over 200 models on Vertex for the developer community. So, Google makes the point that they are the only hyperscaler with a true foundation model. And so they make that point. You say, so what? Well, they're in that game. And so they get visibility and they're able to tightly integrate that into all their products. At the same time, with 200 models in Vertex, they're also offering choice. So Amazon offers choice, but it's got its own Nova model, which is not generally considered the world-class foundation model like an OpenAI or an Anthropic or a Gemini. We'll see if that holds. Amazon would probably disagree with me on that, but so be it. And then of course, Microsoft doesn't have its own model, even though rumors are that it's working on one. It relies on OpenAI. So actually, Alex, go back to that one more time if you would. You can see this is a blend of public statements, CUBE research estimates, 10K, 10Q reports, and you can see the notes here. We'll publish this in our breaking analysis of what's included. It's actually quite confusing, but just note that all public cloud includes, for Microsoft, includes Azure, all of its SaaS franchises, Office 365, Dynamic 365, LinkedIn, security, developer clouds, industry-specific clouds, whereas AWS, as I said, is all in. Google includes Workspace plus GCP. All right, thank you, Alex. So let's now take a look at some of the positives and negatives that came out of this quarter, and we'll dig into each company. Let's start, Alex, with Microsoft, if you would. So the pluses here, this was probably the most upbeat conference call maybe ever, I've heard from Satya Nadella and Amy Hood and the Microsoft crew, and the number of congratulations that the Wall Street analysts put out there. Now, as I was saying before, I was alluding to the on-prem legacy leverage and opportunity that Microsoft has. And a lot of people think, well, legacy business, on-prem business, that's declining, so that's a negative. Not necessarily. Microsoft makes a lot of money on its on-prem estate. And so if you're thinking about moving to a cloud, and Microsoft is giving you a substantially identical experience in its cloud, why wouldn't you just stay with Microsoft? Oracle's got this play with Cloud a Customer, where it's essentially substantially the exact same operating model. Microsoft's on-prem stack is very similar. Maybe it's not identical, but still, you got a relationship, move it into the cloud. So we see this an advantage relative to the pure play public cloud, specifically AWS. It's got to bring Outpost, and Outpost is not as mature as some of those on-prem stacks. And look, that's 16 points of AI growth from as part of Azure growth. I mean, that's about half of Azure's growth. Azure grew at 35% constant currency, nearly half, high 40s, mid to high 40s of that growth comes from AI. So it could be as high as $3 to $5 billion this past quarter. And the other thing is on CapEx flexibility. Microsoft has sort of been hedging. You hear a lot of rumors, they're dialing it down, they're going to crank it up. Well, CFO Amy Hood said that fiscal year 26, the spend growth is going to slow if Microsoft needs to. So they will slow that down. And so the point is they can pull the lever down and dial down if the macro warrants. The negatives, there weren't a lot of negatives in the quarter, I got to say. Microsoft just absolutely crushed it. But they do hide the ball on profitability. Azure is clearly pulling margins down. They'll talk about gross margins being affected. I think gross margins for ICE Intelligent Cloud are now under 70%. AWS and Google are more transparent, certainly for operating margins. And again, capacity shortages. I mean, is that necessarily a bad thing? I mean, if you can't meet demand because you don't have the capacity, that's not necessarily a good thing. But I'd rather have that than there's no demand. Go back to the 2001 to 2003 timeframe, post.com boom. It was, Silicon Valley was empty and sort of like a desert. Those weren't necessarily good times. So I'd rather have this problem than that one. All right, let's dig in, Alex, to AWS's pluses and minuses if you bring that up. AWS beat, according to us, but they weren't not according to Wall Street. We had AWS cloud growth at 16% this past quarter. It actually beat our estimates. It came in at 17% at just over 29 billion. So, we saw that as a positive, but the financial analysts, they were more aggressive, so they saw it as a negative. On top of Azure's 35% growth, people said, oh, AWS, they must be hurting. Well, we don't think so. I mean, AWS is a margin monster. They've got almost 40% operating margin. That's not gross margin, that's operating margin, which is very impressive. They've got the most mature custom silicon stack, Trainium 2's kicking in, and Inferentia. So that leaves AWS less exposed to NVIDIA's pricing. They're basically taking their Graviton playbook and bringing it over to its AI business, which is smart. Google also has that advantage. And look, Microsoft with Maya, they're copying that same playbook. They're just not as mature and haven't been at it as long. And a lot of agents. They're moving up the stack with their agents. They got Bedrock. They talked about Agent Designer, and they're simplifying these workflows and processes. And so we saw that as all positive. Their revenue is still a little bit lacking, if you will, in terms of SaaS. They really don't have a SaaS business. This bullet here is, maybe it's unfair to AWS, it's still opaque versus the core IaaS. The core IaaS, they're pretty clear on it, but the $117 billion run rate, people, investors in particular, want to hear a stronger story. And that's why the stock was taken down today, the day after the announcement, is because people thought the guidance was pretty tepid, but I don't see it as a problem. I think they brought down the low end of the guidance, and so that has people concerned. To me, that's just prudent. A lot of companies are doing dual levels of guidance. If tariff persists and we go into recession, this is the guidance. If things stay normal, this is the guidance. Some people like that. I think this is just AWS's technique to simplify it. Why do that? Why not just give a wider range? I thought that was smart. Again, capacity is the gating growth. Their revenue's tied to their ability to go live with data centers. And so, the comments from Jassy on the call and management on the call were, Brian Orlovsky, who's the CFO, were like, this could be variable throughout the year. And again, the lack of SaaS means AWS misses out on the higher margin opportunities that you see from Google and Microsoft. So speaking of Google, Alex, let's jump into Google and talk about the pluses and minuses there. Google announced last month, but so we're taking the opportunity from the earnings of Microsoft and AWS to update the Google, update our audience on Google. The big headline here was their overall cloud growth was 28%, which is less than Azure, yes, but we have GCP growing faster. We have GCP growing at 36%, just over Microsoft Azure's 35% in constant currency. And so we have these guys growing, surpassing $27 billion this year, still far behind AWS and Microsoft, but we're seeing improvements in that business. Google has a very strong TPU roadmap. They announced the next generation tensor processing unit at Google Cloud Next. They've got early access to Blackwell, as do all the hyperscalers. So, they've got choice like the rest, but they are being clear about their investment cadence. They've put a stake in the ground on $75 billion. And so that we saw as a big positive. Like the other players, they're supply constrained through the fiscal year, which is their calendar year, which, depending on who executes better, it could affect growth rates and give share to some of the other players, although we still think Google's going to grow at the same pace as Azure and faster than AWS, so it will be a share gainer this year. Margins are still tight. This is operating margin, in less than 20%, but they've improved in the past 12 months, but they're still, way below the levels of where AWS reports and where we think Azure is. They recognize on-prem and hybrid, and they've actually got a decent SaaS layer, but it's confined to the workspace area. They don't do a lot of other stuff, but it's not the same advantage that Office has. But it's good. It's a good business, and it's something that is an advantage for Google from a margin standpoint. But given that half of its business we think is coming from the software side of the house, you would think its margins are better. That just gives you an indication of how much it's investing in a Google Cloud Platform. So that's something that we'll watch. All right. So what does this all mean? Let's bring it all together. And Alex, bring up the next slide, and we'll talk about our annual figures. So let me just go into the quarter. So just a review for the quarter, AWS Cloud grew at 17%. Now this is just IaaS and PaaS. So we're stripping out the SaaS to make an apples to apples comparison. AWS was up 17%, Azure was up 35%, GCP up 36%. Alibaba is an estimate. They haven't reported yet, so we got them at 15%. The overall total for the big four is at 25% this quarter. Some people debate that Alibaba shouldn't be in the big four, but we count them in there. And then, so what does that translate? That's $29 billion for AWS, $22 to $23 billion for Azure, $6 billion for GCP, and we think Alibaba will come in just over $3 billion for a total of well over $60 billion just for the quarter. I mean, it's just astoundingly large business. The three, comprise, a revenue that's bigger than Cisco, which is a big company. At any rate, so the big three this year we think will surpass $245 billion. That's a 25% growth rate just for those three, and they'll prop up over 25% growth rate. They'll prop up Alibaba, as you can see there, which is growing a little more slowly, although it wouldn't surprise me to see Alibaba, report strong. They get the China factor, so it's a little harder to sort of squint through that from sitting here from Massachusetts. The Microsoft Azure growth acceleration that is just so impressive. And again, the caveat there, it's a combination of the momentum that they have, but it's also the games that they're playing definitionally. We knew this was going to happen. We had a whole breaking analysis on that segment on that, basically shrinking the pie so that it grows faster, so they can report faster growth and get everybody excited. Very clever. Got to give Microsoft props for their communications savvy. So again, Azure and GCP we have growing at 35% this year. You can see that, and AWS growing at about 18%. So we do expect AWS to accelerate, assuming it can figure out how to deal with its supply challenges and its energy challenges. And Azure's AI is meaningful. AWS and Google still a little bit opaque on the AI front. And so that's something that, again, we call your attention to. But overall, cloud business looking pretty good, and these three are leading. The other thing it says to us is that there's a lot of concerns, of course, about potential because of the tariffs and potential for stagflation or recession or inflation and uncertainty, et cetera, et cetera. But as many people have pointed out, and we would totally agree, the Mag 7, they have the ability to navigate through this because they have such impressive cash flows. And companies like Apple as well, who are dealing with major issues in China, we think these companies have the resources and the capacity to figure these things out. It might take some time, but we think long-term they thrive. All right, I want to introduce you to something that we haven't shared on breaking analysis before. Alex, bring up the next slide. So this is data from ETR, and what it shows is we went back to 2021 and we're plotting Azure in the orange, AWS in the sort of greenish, and Google in the light blue. And what we're plotting here, you can see in the red, we said shared net score. What is shared net score? Shared net score is an indication of the spending momentum for each of these companies within the survey of 1,859 respondents. These are IT decision makers, they're senior people. ETR has been doing this back to 2010. So this is a pretty good sample. Now, again, net score is the net percent of customers that are spending more on a platform. So this is the cloud computing sector. You can see we've selected on that and we're saying shared net score. What does that mean? It says the net score in the accounts within those 1,859 that are purchasing either respectively Azure, AWS, or Google. That red dotted line at 40% means it's a highly elevated net score. So you can see the net scores over time have come down from 2021, where we were kind of in that peak, COVID, everything's got to be done in the cloud world. So they have come down, and they're coming down, they continue to come down given the macro headwinds, but they are highly elevated as a category. They're significantly up there. It's a little concerning to see Google's dip. This is a forward-looking metric, by the way. We're asking them what their spending is going to do, going forward. But nonetheless, all of them are either above, Azure and AWS are well above the 40% mark. Google has been hovering around that. So that's very interesting. And you can see, again, there's a little bit of a headwind, but still, very, very strong spending momentum. But what's more interesting, Alex, when you go to the next slide, is when we look at overlap. So what is overlap? Overlap is the account penetration inside of those 1,859. So the previous one was the spending momentum on those respective platforms. This is how penetrated, the percent penetration within those 1,859 accounts. So Azure is penetrated in more than 60% of those accounts. AWS is almost 50%. Google is climbing up. And look at the progress Google's made from well below 20%. Now it's hovering up to the 30% range. And you can see in the upper right, we show the net score and the shared N. So the shared N is an indication of that penetration. The net score is that spending velocity. And you can see all three are in the green on the net score side. So this was just another way to kind of look at the data and just sort of underscore the momentum that these cloud guys have and the wallet share that they continue to gain. Now let's close by taking a look at some of the KPIs that we're going to focus on, going forward into the rest of 2025, into 2026 and beyond. So we'll dig into each theme. We'll talk about the KPIs that we're looking at. We'll give you the bull case and the bear case. So the first one is, everybody's talking about Agentic. I'm 30 minutes in here, first time I've said Agentic, so congratulations, Dave. But look at, agents are real. They're exciting. We're moving, beyond RAG-based chatbots and just Gen AI as a standalone thing. And we're moving beyond single agent systems to multi-agent systems and agentic adoption, agentic systems. This is super exciting. George Gilbert and I have talked about this a lot in our interview with Mark Benioff. If you haven't seen it, by the way, watch that interview with Mark Benioff. It was a 50-minute interview. We went deep into agentic. Mark got technical. He not only gave his talking points, which are actually quite good, but you can get those anywhere. He dug into the technology, went much, much deeper than I've heard in any of the other podcasts that he's done. So you want to check that out. So one of the things that we're going to watch here is the monthly active agents, the token volume, any disclosures around agentic adoption is something that's really, really important. So the bull case here for the cloud is that enterprises say, wow, the agentic stuff on the cloud is better. So I'm going to start moving my core workflows in not only the ones that are in the cloud already, where a lot of my data is, I'm going to move more workflows into the cloud and drive a new wave of cloud migrations. So that's the real bull case. The bear case is, people are kind of getting proof of concept fatigue. They're in POC purgatory, it's called sometimes. So, and I'll tell you, a lot of customers are telling us that they're not a lot, more than a lot, most are saying we are building an on-prem, certainly large ones like large banks, we are building an on-prem AI stack. Cloud costs are too expensive and we want control. And so we've got to build that on-prem AI stack. And so to the extent that cloud is seen as too expensive, and the on-prem folks can build ecosystems that are comparable to the cloud, and that on-prem stack, AI stack kicks in, you could see, a little tug of war, continued tug of war. This isn't repatriation. Repatriation was never a massive trend to the extent that it stole business from the cloud. But we could see the on-prem AI, to the extent that they get it right, the vendors and their customers get it right, maybe it doesn't steal from the cloud. We don't expect that, but it could halt that bear, could attenuate that bear case, to use an Andy Jassy word. All right, next line is power and water constraints. So the leading indicator here is, what are they doing for land bank deals? What are they doing for green energy PPAs, which stands for power purchase agreements. How are they getting around that barrier right now? And what about these new modular, nuclear data centers or nuclear facilities? Nuclear fission is a big thing. What about renewables to unlock, some of that opportunity here? And what about these latency tolerant workloads, moving to, say, sovereign locations that the cloud actually builds out? The flip side of that, the bear case, is you got permitting drags, we're short on power becomes the status quo. What about nuclear fusion? Not only fission, but what about fusion? That could get delayed even further, and it's still pretty far out. The thing about fusion that's attractive is it doesn't use enriched uranium. It throws off a dramatically less waste. It's really minimal. Some people would argue none. It's not none, but it's very, very minimal. The other piece here is China. We've seen what Huawei has done with its response to Blackwell and NVLink 72, NVIDIA's networking capability. Huawei's come up with a big, honking, really powerful, power-hungry machine that they are just pointing in brute force to help train AI workloads. So But you might say, well, their power, their flops per watt is not good. Well, but so what? If China's got tons of power, which we hear about all the time, they could potentially get around that with just a brute force strategy. That's something that we're watching. And for the rest of the world, maybe not for the US with the new protectionist stance, but for the rest of the world, that could open up opportunities for China that could siphon opportunities from the big three US hyperscalers, sort of a balancing act with public policy. All right, Alex, bring that last slide back up. Let's talk about custom silicon ramp. How much of the AI training is going to be spent on Trainium and TPUs from Google and Inferentia versus NVIDIA GPUs? AWS will give little tidbits every now and then. They talk about Graviton and the percent of new workloads that go to Graviton, and they'll do that very respectfully. They don't want to tick off their other partners. Used to be Intel and AMD, still is, but now more so NVIDIA. So we'll be watching that. The bull case is the cost curve bends. These hyperscalers can maintain some of their pricing power. They can bring in, it drags other services in to the cloud. We actually think that's very likely. The flip side of that is that software tool chains are going to maybe not keep pace. And customers may say, hey, we want CUDA. The CUDA value outweighs the lock-in risk. And so that's going to be interesting to watch, and NVIDIA maintains its pricing power. It's likely going to be a combination of both of these things. The next line here, hybrid sovereignty. We're hearing a lot about sovereign AI in the EU and APAC and the Gulf states. And this number of sovereign cloud launches is something that we're going to watch. And it's not, hyperscalers aren't alone there. Certainly, Oracle is playing in that game. IBM, has some capabilities there. Dell is supplying the likes of the Equinixes of the world, as are Lenovo and HPE and Supermicro, so keep an eye on that. But the bull case here is that Microsoft and Google, they're going to monetize their gov cloud premiums, AWS as well. I don't know why I left AWS off the chart. I would also add in, and I'll do the update, Outposts, is starting to gain traction with its, on-prem. And then the bear case here is that all on-prem alternatives offer better economics and better service. We've heard the war stories about, they don't get great service from Amazon with Outposts. Now maybe they're dealing with that because their ecosystem is maturing, but that's something that, you want to watch. The key here in our view is when you think about how the on-prem players like Dell and HPE and others responded to the cloud. They were slow. I would say Oracle as well. Although Oracle had announced years ago the sort of cloud at customer and the same strategy. It just took a while for them to get their cloud right. But once they did, they competed very effectively, as today do the on-prem players. We've seen that in some of our data. Whether it was VMware, it still is VMware, or suppliers like HPE and Dell and Lenovo and Supermicro selling to on-prem, that balanced things out. So the thing we're watching, my point is, if it takes 10 years, that's going to favor the bull case, for the hyperscalers. If, however, they can close that gap on bringing AI to the data on-prem much faster than they did in the early cloud era, where it went from poo-poo, you're a bookseller, there's no service there, on and on and on, to, oh wow, we better get our act together and actually start investing. It took the better part of a decade, probably more than a decade, for the on-prem guys to have, a substantially similar, simplified operating model. They finally got there. If it takes that long, it's the bull case. If they can compress it, that's going to be an interesting little tug of war and competition between the on-prem model and the cloud, cloud's ability to compete for hybrid sovereign AI. Okay, last one, Alex, if you bring that same slide back up. Got to add public policy in. The DOJ, the FCC, the EU, China tensions, the whole regulatory climate. So the bull case is that the drive for innovation trumps the monopoly and the oligopoly fears. Lena Khan would say, I hear that all the time, but it's a legit argument. If we want to compete with China, you're basically, by trying to break up Google and attacking AWS and Amazon and putting your foot on the neck of the hyperscalers, that hurts innovation. So, at the same time, in the bear case, governments globally could crack down on these internet giants and that could constrict growth. Or even, trying to break up firms would be, really disadvantageous for firms like Google. So that's something, again, that we're going to be keeping an eye on and watching on a quarterly, annual, quarterly, monthly, daily, monthly, quarterly, and annual basis into 2026 and beyond. Okay, so what do you think? What are you seeing? Where are you putting your bets? Are you putting them on-prem? Are you putting them into the cloud? Are you able to get data center capacity on-prem? Are you able to find the power? Are you leaning toward the cloud? Are you in POC purgatory, or are you starting to really scale those cloud AI workloads? And where are you on Agentic? Let us know. Okay, we'll leave it there for now. I want to thank Alex Myerson, who's on production and manages our podcast, and Ken Schiffman as well. Kristen Martin and Cheryl Knight, they help get the word out on social media and in our newsletters, and Rob Hof is our editor-in-chief over at SiliconANGLE.com. Thank you all. Remember, these episodes are all available as podcasts wherever you listen. All you got to do is search Breaking Analysis Podcasts. I publish each week on thecuberesearch.com and SiliconANGLE.com, and you can email me if you got a pitch. Send it my way, david.vellante@SiliconANGLE.com or DM me at @dvellante. Comment on my LinkedIn posts, hit me up there. Don't be offended if I don't respond, but please keep trying. We get inundated with inbounds, but we do look at them all, and very often we'll invite folks on to Breaking Analysis. And by all means, check out ETR.ai. I think it's some unbelievable stuff coming that they were sharing with me this past week at RSA. We dug into that RSA survey, the annual state of security survey. Unbelievable. Go to their website, ETR.ai. You can download that for free. And they got some new stuff coming as well on AI, which I'm really, really excited about. So best survey data in the enterprise tech business. Anyway, that's it for now. This is Dave Vellante for theCUBE Research Insights powered by ETR. Thanks for watching, and we'll see you next time on Breaking Analysis.